So in this video, I will be recording the topic of return from shares. The value of a share of common stock depends on the cash flows it is expected to provide, and those flows consists of two elements. Number one, the dividends the investor receives each year, and number two, the price received when the stock is sold. So you have already done bond valuation, and you know what are the three steps for valuation. Number one is that you estimate the cash flows that you will get from that financial investment. Number two is that you will use an appropriate discount rate, and number three is that you will find the present value of those cash flows. So you have to do the same thing for stock valuation as well, and in order to do that, you first need to understand that what are the cash flows that come from shares. So if you are a shareholder of an organization, the first thing you might get is a dividend. A dividend is a profit distribution by the company. Now, for the management, it is not compulsory to pay a dividend, and for common stockholders, there is no fixed dividend as well. But for preference shareholders, there is a fixed dividend. But even if that dividend is not paid, the company does not go bankrupt in this case. So, if the company is going into losses, they can actually skip the preferred dividends as well. So first is the dividends, and the second is the price received when the stock is sold. So if you will keep the share with you till infinity, so if you have no plans of selling the share at all, the only cash flow stream that you can get from a share is the dividend. But if you plan on to sell the share to somebody else, or at some point in time you do sell the share to somebody else, and there is another cash flow that you will get at that time, which is the selling price of the bond. So whatever is the market price of the bond at that time, you will get that amount. Again, this is different from bond valuation, because in bond valuation at the maturity time you get the par value back, which is fixed and you know it from the beginning. But over here, the selling price can be anything. Now let's look at an example to understand this. Okay, before going on to the example, let's first look at the formula. So the formula for expected return is the percentage yield that an investor forecasts from a specific investment, and the formula is dividend yield plus capital gain yield. So like already discussed, the return comes in two forms, the form of dividend and the form of capital gain. The formula for dividend yield is D1 divided by P naught. D1 over here means dividend at the end of the first year. P naught represents price, the current price. P1 represents the price at the end of the first year. P naught represents the current price, and again P naught will represent the current price. R is the expected return. So here is an example. XYZ Corporation's current stock price is 25. So this is the current stock price. We make a timeline. Current means present value times 0. This is the current stock price, and you will denote it by P naught. So the 0 is representing the timeline. So it is at time 0, that's why P naught. If you hold it for 1 year, you will receive a dividend of 2. So if you hold it for 1 year, you will receive a dividend of 2. This is your D1. D1 is 2. The D stands for dividend, and 1 means that the payment is coming at the end of the first year. You can sell the stock at the end of the year for 27, and you can sell the stock at the end of the year. So this is the end of the first year, and this is the start of the first year. At the end of the first year, you can sell it for 27. So this is again P1, and this was P naught. Okay, so I hope these notations are clear because this is important and we're going to use these notations. The letters represent what we are talking about. So P represents for the price of the stock, and the notations with it represent which year we are talking about. So P0 means time 0, D1 means time 1, and P1 means at the end of year 1. Similarly, if we had a dividend at the end of the second year, it would have been represented by D2. A dividend at the end of the year 3 would have been represented by D3, and so on. So what is the expected return in this case? The formula for expected return is dividend yield plus capital gain yield. The dividend yield is D1 over P0, and the capital gains yield is, yes, so let's plug in the values. D1 is 2 and P0 is 25. The price at the end of 1 year is 27 minus 25 divided by 25. So if you solve this, your answer is coming 0.08 and 0.08 for this as well. So 0.16, 16% is your expected return. Expected return is denoted by a R hat. Okay, so this is your R hat. This is your expected return. So if you purchase a stock, you will have to buy it for 25 because the current stock price is 25. So 25 is your investment. On this investment, you're getting 2 rupees in the form of dividend, or $2. $2 in the form of dividend. So your dividend yield, the amount, the return coming in the form of dividend is 8%. Similarly, the stock price has also gone from 25 to 27. So you are gaining $2 over here as well. So again, you're getting an 8% return, but this time in the form of capital gain. So your total return is 16%. Okay, so I hope this question is clear. Moving ahead, so you can even have the solution in your slides. Now another question is that the current stock price is 20. So the current stock price, which means P0, is 25, and the expected price after 1 year is 22.5. This is 20. If investors' required return is 18%, so if R is 18%, what percentage of dividend should the company pay? So you're supposed to calculate the dividend yield over here. Again, we're going to use the return formula. Now, when the market is in equilibrium, your required return can actually be equal to your expected return. Both are different things. Expected return, you're talking about the future. So what is the return that you will get in the future? Whereas required return is a minimum benchmark. Your investors need that much return in order to make an investment. यानी कि required return से कम के ऊपर वो investment नहीं करेंगे, वो आपका benchmark है. Whereas expected return is कि future में क्या return हो सकता है. दोनों different things, but they are equal in when the market is in equilibrium. That's why they can be used interchangeably. So over here, the formula for your expected return can also be the formula for your required return if the market is in equilibrium. So R is equals to dividend yield plus capital gain yield. The formula for dividend yield, we do not need it because it's asking you the percentage of dividend should the company pay. So it's asking you the whole dividend yield. The formula for your capital gain yield is this. We're going to plug in the values. The R is 18%. P1 is 22.5, P naught is 20, and P naught is again 20, so 0.18. If you solve this, your answer will come 0.125. Now over here this is plus, on the other side this will become minus 0.18 minus. So 0.055 is the dividend yield. It's yield, so you should convert it into a percentage, multiplied by 100. 5.5% is your dividend yield. Okay, I did not put over here the formula because it was asking us for the whole dividend yield. So there was no need to break it into D1 divided by P naught. If it had, the question had asked what dividend should the company pay, then it would have been asking you for D1. Then you should have used the formula over here, and then you should have calculated for D1. Right now it's asking you for the whole fraction. That's why I used dy over here. Okay, I hope this is clear as well.